In this video, I'm going to talk about what happened at Silicon Valley Bank, what were some of the unique risk factors that made them susceptible to this type of bank failure. I'm going to talk about some of the differences between the Canadian and US systems. And then finally, I'm going to close with some information about what would happen or what protections are in place for Canadians in the unlikely event of a bank failure. If we haven't met yet, my name is Mark Walhout. I run an investment management and financial planning firm called Walhout Financial. I help people prepare for and live their ideal retirements, and I created this channel to share ideas and tips that I'm using to help people with their retirements every single day. So if you want to get more videos like these, consider subscribing to the channel. Hit the like button if you like this video, and leave me any questions or comments that you have below. So I'm going to go ahead and share my screen. We're going to talk about what happened at Silicon Valley Bank. There's a lot of news articles that are out there talking about what happened. I want to focus on what it is about Silicon Valley Bank that made that situation unique. So the first thing that jumps out at me about Silicon Valley Bank is that they had really poor risk management practices in retrospect. So they took deposits from clients. They held a portion of those deposits in cash so that they could honor any withdrawal requests. And then they took the rest of those deposits and they invested them into longer term securities. Now, the securities themselves weren't necessarily risky per se over the long term. They held a large portion of long-term government bonds as well as mortgage-backed securities. If they'd simply been able to hold those securities through till maturity, they would have presumably received most or all of their money back with some interest over that time frame, over the intervening time period. The issue came into play in 2022 when interest rates rose rapidly. It drove the prices or the current values of their bond portfolios down. And if you want to learn more about bond pricing and how bond prices move as interest rates rise, I did do a series on bonds, which you can scroll down and find. I might even try to embed a link in this video if you want to learn more about how bond prices respond to changing interest rates. I want to keep today's video focused on SVB, but in essence, what happened was they took too much of their depositors' cash and invested it into securities that had temporarily gone down in value. And then when all of their clients came together at the same time needing their money back, they were unable to honor those requests. They were forced into a position where they needed to sell some of their long-term bond holdings in order to raise cash. And when word of this got out to their clients, it created a bank run, a panic or a frenzy where everybody wanted all their money back all at once. So the first issue was poor risk management. They had too much of their portfolio in longer-term securities that weren't suitable for withdrawal requests from their clients. And then the second big one was concentration. So their client base was very highly concentrated in Silicon Valley, medium and large technology companies that had a very difficult year as an industry last year. And when the whole group of them made withdrawal requests too rapidly or needed too much of their cash back, it created a situation where the bank just had way too many redemption requests, and it created a run on the bank. So they were just, in terms of their client base, they were not nearly diversified enough to sustain a period where all their clients would need to make withdrawal requests all at the same time. So they just had too many of their eggs, their proverbial eggs as far as clients go, in one basket. So let's talk a little bit about the Canadian system and contrast it to the US system. And this is kind of where I'm going to draw the reasons why I think that a similar situation that unfolded with Silicon Valley Bank over the past week and a half is relatively unlikely to happen in Canada. So the first thing that jumps out from this chart is just the sheer number of banks in the United States. There's about 5,000 banks in the United States, just under 5,000. This is as of 2018. And the large 5 banks in the US make up just about a third or just over a third of the total market share. Contrast that to Canada, we have a much smaller number of banks, and our big 5 banks hold about 90% or just under 90% of the market share in Canada. Now, just being a large bank doesn't necessarily make you immune to a bank run. I don't think that that's possible. But what that does mean for Canadian banks is that the clients of Canadian banks are much more diversified and spread out all over the country. So the chance that we could have an economic season that would impact all depositors the exact same way and create a situation where all of them would want more cash than the banks had available to honor withdrawal requests all at the same time is relatively less likely to happen as what happened with Silicon Valley Bank, where they had so much of their client base concentrated in the tech sector that all went through such a coordinated, difficult time over the past year and a half in the United States in particular. So we're much more diversified up in Canada in terms of the client base of our banks. So that's one reason why I think that we're less likely to be susceptible to a similar situation. The second one is Canadian banking is under a much different regulatory environment. And I'm not going to pretend to be a regulatory expert, but I feel comfortable saying that the regulations around Canadians' big banks in particular is much more stringent than the regulation that was around small banks in the United States. And Silicon Valley Bank was considered a relatively small bank in the United States, even though they were fairly sizable in the Canadian context. In the US context, they're relatively small. So the regulation in Canada around banking is much more significant for our large banks. In fact, that regulation has been updated and upgraded as recently as 2018 to create more streamlined procedures in the event of a bank failure to make sure that clients are supported and that the bank is still managed in an orderly fashion. So there's just a lot. Those two reasons, I think, are the big two reasons: much more diversified and a more stringent regulatory environment up in Canada. Why I think that a similar style bank-run bank failure is less likely to happen in Canada. So finally, what would happen in the event that we did have a bank failure in Canada? So over the past week and a half, you've probably heard a lot about FDIC. That's their deposit insurance regime in the United States. We have a similar deposit insurance program in Canada. It's called CDIC. And this chart you can find on the CDIC website. And it talks about the coverages that are in place for you for your cash deposits at Canadian banks in the event that there is a bank failure. So if you have if your bank fails, as long as you have less than $100,000 in a cash account in your name, you have full coverage for that account. Plus you have another up to $100,000 for a joint cash account that you hold with you and another person. Another $100,000 for a cash account or cash-like instruments you have in a tax-free savings account. Another $100,000 for RSPs. So you can see that the coverage now is starting to stack up quite a bit for the unlikely event that there is a bank failure in Canada for cash deposits. Now, I keep saying cash deposits because it is an important distinction. Instruments or accounts that are held that have holdings in mutual funds, in ETFs, in stocks, and in bonds, those are not covered by CDIC insurance. There are different coverage regimes and different programs that are in place in the event of a market dealer failing. Now, that's beyond the scope of this video. If you are interested in learning about that protection regime, I'm happy to do another video on that. Just leave me a comment below saying I'm interested in learning more about the protection regime for stocks, bonds, mutual funds, ETFs in Canada. But today, I wanted to focus on SVB bank failure, the difference between the banking system in the US and Canada, and the protection that is in place in the unlikely event of a bank failure in Canada. So in closing, what we see going on in the United States is certainly cause for concern. If you're sitting in Canada and wondering, could that happen here? Again, I can't guarantee that a bank run wouldn't happen to one of our large banks in Canada, but for the size of our banks, for how diversified they are, and for the higher regulatory regime that exists here, I think that the likelihood is as close to zero as possible without being zero. And hopefully that gives people some comfort that the cash that they hold in their Canadian banks is safe, and that a similar situation is less likely to unfold up in Canada. If you like this video, give it a thumbs up. Leave me any questions or comments below, and I'll speak with you soon. Take care.